What is asset inflation and its link to intrinsic value? Have you ever wondered why some assets seem to skyrocket in value while others remain just stagnant? Today, we will unpack the concept of asset inflation and its connection to intrinsic value. Asset inflation refers to the increase in prices of various assets like stocks, real estate, bonds, and even luxury items. This rise often happens when central banks reduce interest rates. Lower interest rates make safer investments less appealing, prompting investors to seek higher returns in assets, which drives their prices up. Unlike general consumer price inflation, which affects everyday goods and services, asset price inflation can occur independently. It is primarily influenced by monetary policy and investor behavior rather than the supply and demand for consumer goods. This distinction is essential to understand how asset inflation operates in the financial world. Now, let's talk about intrinsic value. This term refers to the fundamental worth of an asset, often calculated based on expected future income or cash flows. For instance, the intrinsic value of a stock is typically estimated by determining the net present value of its anticipated future earnings. When asset prices rise above their intrinsic value, it signals that the market price exceeds what the asset is fundamentally worth. This situation can indicate an asset bubble, where prices are driven more by investor sentiment than by actual economic fundamentals. When asset prices inflate beyond intrinsic values, there is a risk of a sharp correction. This can lead to financial instability or economic downturns, which is a concern for central banks. They often focus on consumer prices, so managing asset inflation can be challenging. Understanding asset inflation involves recognizing how low interest rates and monetary policy push investors toward riskier assets. It is also crucial to differentiate between price increases driven by solid economic fundamentals and those fueled by speculation. The importance of intrinsic value serves as a benchmark for assessing whether rising asset prices are justified or inflated. In essence, asset inflation is the rise in asset prices often linked to low interest rates and investor demand. Intrinsic value represents the fundamental worth of those assets. When asset prices exceed this fundamental worth, it can signal potential bubbles and risks in financial markets. By grasping these concepts, you can better navigate the complexities of investing and understand the dynamics of asset inflation.